I think the only way to get video is to go through Zoom.
Yeah, and if any of you guys need to share screen, just let Jonah know. You can send a message and you can be the host, right?
Yeah, no need.
Yeah.
So just to tell you, I did go through Zoom, and when I got on Zoom, it said no audio, and the only option for audio was to call in. So that's what I did.
Strange. Yeah, okay, it's all good. We just can't,
That's okay.
Yeah.
I've gotten older. It's not necessarily a completely positive proposition.
Well, I still hope to see. I want to see. So we'll do that later. Okay.
It's me. I'll just say.
So when Tony, I ask you to speak, you're going to have to make sure that everybody in the room where you are is quiet. Okay. People rolling in. Is Jonah letting people in? Okay.
Okay.
They're just automatically admitted. I don't need to do anything, it looks like.
Okay. So Charlie, when did you stop working at the OCC?
I guess it was the end of March.
Okay. And so since then you've been reflecting on your experience. Presumably, I've read the Cato piece. I loved it. I think it's great. Hopefully you're going to be producing a lot more content around fintech. Look forward to it.
Unless I'm assassinated first, you never know.
Right. Well, I guess the banks aren't too excited about all of these. It's funny. I know a lot of people at Wells Fargo, and there are plenty of people at Wells Fargo that still seem to believe that people want to go to branches and want to use. I mean, it's incredible.
It's the most powerful principle in social science. It's called cognitive dissonance. No one likes to think about things that are painful.
Yeah. And the other thing that they say is, oh, just wait. The minute we have a downturn, all the fintechs are going to go out of business. That's the
yeah, it's complete nonsense. But the problem is, which of course it was really the point of my article, is economics is pushing very hard in favor of a fintech future, and I mean with huge economic advantages. But politics is the more powerful force, and the lineup of people who don't want to see it happen, the incumbents that want to stop it, are not just the big banks, but also the Federal Reserve and very powerful forces in Congress. And they've all got strongly aligned incentives. And it's now clearer and clearer since I wrote that piece that they are all working together. And I would say not even hiding it anymore.
Well, they say banking, medicine, and education are the three most highly regulated businesses. I actually think that finance is making more progress than education, but that's a conversation for another day.
Well, that's like a race to the bottom. I'm not sure who's going to win that one, but yeah, it's going to be interesting because I think the fact that we're having this conversation, there's so many people who can see visibly the advantages of allowing progress, so that we can move out of our 19th century payment system, so that we can move out of our very backward brick and mortar banking system and all this these weird business models that are so wrapped up with the regulatory relationship that they almost have forgotten the customer relationship. Now the economics of those customer relationships has changed so much. And the people who are all wrapped up in their little political regulatory relationship don't really want that to happen. And so it's this wonderful conflict. I mean, the buggy whip coalition is very powerful, much more powerful than the makers of buggy whips ever were.
I love that term, the buggy whip coalition, that was in your piece. Maybe we can just start making this the formal part, Tony, of the conversation. So I'm going to introduce everybody, and then as people start rolling on in, they can join the conversation. but I want to start by introducing Professor Charlie Callum. I'm Greg LeBlanc. I teach at Berkeley and Stanford and HEC Paris, and I teach courses in data science, digital transformation, fintech, blockchain, and related subject matter. I also have been doing quite a bit of work, advisory work, and stuff in fintech space, and also have a podcast, which I can talk about later. But I want to introduce our three panelists. We have Charlie Calameris, who's a professor at Columbia Business School, joining us, I thought from New York, but in fact from somewhere else in the middle of the country. And he is where the Wi-Fi is not great. And he is also the head of the program for financial studies at Columbia, and has just stepped down from the Office of the Comptroller of the Currency, which, as we all know, is the #1 regulator for the banking industry. So he is a regulator. He's been there and back, and he can tell us a bit about that. We also have Jun Kim, who is a general counsel at O1 Labs, and he's also written about some what's happening in the exchanges right now in DeFi. So welcome, Jun. And then we have Tony Chan, who has is a background in the real estate business, but is now the founder of a interesting DeFi company called Pledger, and they are sponsoring this session. So why don't we start off? I want to ask Charlie a question or two. Well, first of all, why don't each of the three of you give a brief introduction to yourselves, elaborate on my introduction, tell us a little bit about how you got interested in crypto, how you got interested in decentralized finance. Start with you, Charlie.
Well, thanks, Greg. It's a pleasure to be here. I'll just mention two things about my connection to this, because I really was never planning to get connected to it. So a company that I won't mention, or I don't want to talk too much about the company, a few years ago recruited me to become the chief economist of this crypto company. And that was a great learning experience for me for a few months. And I developed some very strong opinions about what business models for stable coins make sense and what business models don't. And I also learned a lot about how the future of this, and really being able to think through the future of it, requires you to be able to combine three different specialties. And there's almost no one on the planet who in their own brain does. And that is legal understanding of where the regulation's going and how to think about that. An economic understanding of monetary economics, that is what kinds of stable coin models can work. And an engineering understanding of how to use blockchain, how to create decentralized networks that are, effective, fast, and that are going to deliver all sorts of new technologies while doing that. So what was interesting to me, what I really learned from that, was that we all really need each other in this conversation. And the engineers, these guys, they knew everything about everything, except they didn't know what the first thing was about monetary economics. And frankly, they were designing a product that kind of sucked, to be honest, and it couldn't possibly work. And so it was kind of, that was my first sort of involvement with engineers, was to say, well, wait a minute, this is all great, but you understand what a transacting medium has to accomplish, and what works and what doesn't. Then the last thing I'll mention is then when Brian Brooks was becoming acting comptroller of the currency, of course, Brian has become, even at a young age, almost a legend in the crypto area because of all the things he has done. He called me and asked me if I could recommend a chief economist. And when he told me what he wanted to accomplish at the OCC in the way of advancing technology, fintech, and crypto potentially, I said, I'm coming. And so that's how I went to the OCC, specifically because of my long-standing friendship with Brian and wanting to be part of that. And I learned a huge amount there. Not all of it is about economics. Most of it is about politics and about all the barriers that we're facing to make good things happen. So I'll leave it there. Thanks for asking.
Well, Charlie, FYI, I launched the first course ever that was on blockchain, that was cross-listed in our engineering school, our law school, and our business school back a couple years ago. And like I said, educational systems not moving very quickly. So that was the politics of a course in all three schools didn't work out so well. So I'm not teaching it anymore. But you're absolutely right. We need all three domains to make sense. And every project that I had in that class had members from all schools. We needed a legal report, we needed a technical report, and we needed a business model for all the different proposed projects that came out of that class, some of which actually saw the light of day. June, as a lawyer, you're our legal guy. Tell us how you got into this world.
Sure, thanks, Gregory, and happy to be the third pillar representing the legal side here. So what started for me in my interest in blockchain was when I worked at Goldman Sachs in their legal counsel. That was around 2016, and that's when all the US exchanges started having so much money in their balance sheet because the price of Bitcoin was skyrocketing, and they were contacting all these investment banks and saying like, hey, how do I make yields on this? Right? Like they haven't really thought about like creating a custody chain or anything interesting. And I was sort of the designated person to make that happen. And that's when I first started learning blockchain. Fast forward a year or two, I got an offer to join Terra as its first GC. And when I asked my boss, if I could leave, he said, are you joining blockchain or cannabis industry? Because it has to be one of those for you to quit. That's really when blockchain was starting to pop. And Terra was a really interesting project and based in Asia. It's algorithmic stablecoin. So I'd love to get Charlie's opinion on what he thinks of algorithmic stablecoin. My guess is not so good, but either way, I spent some time there. And one of the things that I helped develop was this DeFi protocol called Anchor. It has quite a large number of assets currently locked in it. And eventually, for personal reasons, I had to move back to US, and I found myself at Mina Foundation, which is a layer one protocol that's focused on privacy and also has keen interest in DeFi. So it all started from my in-house counsel experience at Goldman, and here I am now.
Great, thank you, June. Tony.
Yeah, hi, thank you, Professor LeBlanc, for inviting me to give be part of the panelists here. So my name is Tony Chen. I got in crypto in 2017. Before I was a real estate agent, I helped clients to buy real estate here in the Palo Alto area. And one day, one of the clients asked me to help them buy Bitcoin, and it was in 2017. Bitcoin price was around 4,600, and at the time, that was the first time I heard about Bitcoin, and I realized high net worth individuals see Bitcoin as a new asset class they want to have exposure in. Yeah, that's how I got in crypto. Mm-hmm.
Great. Well, I'll ask you a little bit about Pledger later, but first, let me start off with Charlie, and I want to build on June's question. Look, transaction media have been around for as long as human beings have been around, more or less, and the U.S. has a couple of interesting versions of this, and you're someone who studied the national banking system and all the different the national banking system, of course, began in 1863 and the founding of the Fed in 1913, and there hasn't been that much new in the transaction medium space. We've certainly built out powerful technologies for the transfer of funds, but nothing really transformational until the white paper in 2008. But stablecoins are different from Bitcoin. All the things that people say about the volatility associated with Bitcoin and other coins, you can remove that as a concern when you're dealing with stable coins, at least one would hope. So what is it about stable coins that is potentially good, and what is it about stable coins that are bad? Do we need to have a governance? Do we need regulations? What's your? Of course, I've read the whole article that you wrote about stable coins primarily, but could you tell us a bit about your perspective on stable coins based on what you've seen, not only through your study of the banking system, but your time as a regulator?
So, and my answer reflects both. My view is that for stablecoins to actually take off, we need several things to happen. We need, first of all, them to make sense economically, but we also need for them to work politically. And I really want to focus on that because my answer is going to be the path of least resistance is to push for creating a chartered stable bank, national bank charter. And I really believe that this will work, mainly because, not because it has to be. As I talked about in my article, there's certain economic advantages of the national banking charter for stablecoin providers. But the main thing is, you have to be realistic about what's going to be part of the political equilibrium. And because you have major problems with potential money laundering and tax avoidance and other things, one of the things that you want, of course, you want an algorithmic-based coin. If we want this to operate economically, cost-effectively through blockchain, that all makes sense. And in fact, by having it set up properly, you can have more than just the transaction of payments. You can have the transmission of other information simultaneously at the speed of light with the payment that, well, let's call it kind of selective anonymity, revealing things about yourself that need to be revealed. In fact, that fact can allow the technology to overcome the money laundering and the tax avoidance in a way that makes it attractive to enough people in the country and to the government that it could actually happen. Because if the government doesn't want this to happen, they can stop it. So you have to ask, how do you actually get beyond that? Not as something that you think of as an afterthought, but right up front. And so what does chartering do? It allows algorithms to be examined by a central authority, which also means that they're approved as actually doing what they say they're going to do, which is a good thing for the private market, but it's also good to make sure that you don't have the legal compliance issues I mentioned. So I really think chartering and developing a capability and examination of algorithms is really kind of an essential thing as part of the political equilibrium that makes this even possible. Because if we don't go down that road, we're going to eventually just prohibit the whole thing. The other thing economically that's necessary is that they have to be credibly stable. And that can be accomplished a lot of ways. In my article, I pointed out you don't need to have a deposit structure. You don't need to have demandability. That is redeemability. You don't have to have 100% reserves even. But you do need to conform to economic logic of what makes it credible to be able to maintain the stable value. And so I go through many different options of that. The algorithm can function in the secondary market in ways that stabilize the value. That can be an important part of it. So I don't want to go into too much detail except to say, start with the politics, then go on to the economics, and then talk about the engineering. The engineering, of course, is setting up the network, figuring out how it can be hooked up to people's cell phones cost effectively. How do you get merchants involved? And there are lots of physical science aspects of this, which I think, as far as I can tell, that's no longer the problem. That is, we're overcoming all of those hurdles. So I sort of feel like that's the equilibrium that hits both the political side, the economic side, and the engineering side. And I put the legal side into the political side. So at least that's my view. Very much that an algorithmic, blockchain-based stablecoin is the future of payments. Absolutely, I believe that. But it needs to be thought of very broadly. Start with the politics. Don't save that for last, because if you do, you'll never get there.
But right now, the only legal constraints on stablecoins are contractual, right? So there's no at least in terms of making sure that these entities are have the backing of all the stablecoin, right? It's just contract law at this moment. There's no regulation on stablecoins, is there? I mean, except for FinCEN and transfer of payments and so forth. But the actual reserve and the requirements, that's all contract law, right? I think Charlie, you're on mute. Charlie's on mute. can. Charlie is on mute. Tony, can you have Jonah unmute Charlie? And I think you muted the wrong guy.
Yeah. Sure. Hold on. Yeah, coming.
There. Okay, well, let's turn to June.
Hey,
June,
Jerry, can yeah.
June. I
Did
wanted
that
to
work?
ask you.
Wait, I'm sorry. Did that work?
There we go. Yeah, Charlie. So right now, the only thing that maintains the value of the stable coin is the kind of, open market operations of the stable coin provider, right? There's no.
No, absolutely. I'm thinking ahead, and I'm thinking that you can do this in many different ways. There are many ways to skin the cat of creating credible stability. The reserve backing is one way. I don't think it's the best way. You can do it partially with reserve backing. The open market operations are a good idea too. There are many ways to do it. We shouldn't get hung up on that. But the thing to recognize is, if this thing starts to take off, if this network actually starts to develop, that is when the political forces that are threatened by it will mobilize, say that it's too risky, use a few examples of problems to justify shutting it down. And they can shut it down, because if you're in, the fact that it happens in some, in some cloud environment doesn't mean that it can't be shut down by the government, because they have control of all the physical points of entry, your computer basically. And so I don't think people are thinking ahead, and they're not noticing all of the hostility by the very powerful parties, the Fed especially. The Fed wanting to create its own digital currency is partly about wanting to expand monetary power control, but it's also about wanting to create an alternative to stable coins. And the banks are all over this. They're trying to create a substitute idea, which is far inferior within their own networks. JP Morgan's done that in Europe, for example. And if you look at like who's been nominated for the new comptroller of the currency, somebody who apparently, as far as I can tell, is very hostile to all this. You need to think ahead, guys. It's not just about the business model. That has to be satisfied, but the politics are not good. And that was why, this was really what was motivating, I will speak for myself, my actions at the OCC, and I know many other people at the OCC, that we wanted to create a positive possibility for these things to be part of a respectable system, partly to take off the table what I saw coming, which is this is all going to be attacked and can be destroyed by people with very powerful interests as soon as that network starts looking good. As you know, stablecoins have been growing really fast the last couple of years, but they're still small. Wait till they get a lot bigger and you really start threatening the bottom lines of these and the power of the Fed and the bottom lines of the big banks. And the coalition against you is big. It includes all of the people in the NCRC world, all of the Maxine Waters and Sherrod Browns of the world, because they currently don't have a way to tax these crypto providers. And so they see this as a threat to CRA kinds of investments by banks and other things. And so you have to get real here. This is not just a small economics problem or engineering problem. This is a big political problem. And you have people who hate your guts who have a lot of power. I'll leave it there.
So June, I'd love you to chime in on what you're seeing from the regulatory world with respect to DeFi, right? What regulations are impacting DeFi?
Sure, and maybe before we get there, I think stablecoins are a very important part of DeFi, right? So whatever Charlie mentioned is, in effect, a very important issue, even in the context of DeFi. I think right now, when I was helping sort of devise algorithmic stablecoin, also working with the regulators in foreign jurisdictions, their biggest problem is that they don't understand algorithmic stablecoins. And then the alternative of that is really just a deposit-like function, which makes you wonder, why you're using blockchain in the first place. So completely echo that, and I'd love to, remind everybody on the call that, like, unless you persuade, the forces will be against you, and that's also the pattern that I see down on the in the trenches. But going back to your question, Gregory, I think a lot of people think that DeFi is above the law because it's just a bunch of code, right? How are you regulating a bunch of code, and it's transparent, auditable algorithm that people could just freely use, and they're anonymous developers. It's not subject to law, which is completely untrue. I think the problem here is that none of the legal standards grant you immunity with respect to your DeFi operations, right? So I think there are you could divide DeFi into two groups of players. One is VC-backed, has employees, has physical address, has face, and it's you could subpoena the company. And then there's another group, completely anonymous, and an example of this may be SushiSwap or other projects, where how do you enforce a group of anonymous people, right? But it's very, unless you hard fork an amazing set of codes, a lot of people tend to fall on the first part. And if you do, then you have to worry about federal securities laws, right? If you're, creating governance tokens, you're marketing that, you're selling that, you're airdropping that to people, like it's going to be very difficult for you to argue that the SEC doesn't have jurisdiction over your tokens. Even if you somehow luck out and say, successfully argue that your tokens, governance tokens, are not securities, it's a commodity at the end of the day, right? Like Bitcoin and Ethereum, which means that you have to worry about if you're allowing for derivatives on those commodities, you have to really think carefully. And also there's anti-fraud rules and all sorts of other things that people don't really pay attention to these days. I think also you have to make sure that in certain instances, you may need license. So Gregory touched on this briefly, but Coinbase and Kraken, they all have license in each of the 50 states because of money transmission. And if your DeFi operations trigger that license requirement, you need a license. And then relatedly, this is something that FinCEN also controls, is AML and KYC, right? There is no central authority behind DeFi in most instances. But if there is a regulatory guidance, which there is right now at international level, if US ends up adopting that and impose AML KYC obligations on DEXs, how do you comply with that? So there's all sorts of things, thought of by alphabet soup of regulators that people need to think about, but it's in the beginning stage, in my opinion. So I think these are just a sense of like things that are about to come as opposed to things that already happened. So definitely need to be mindful of those.
So, I mean, we have, as you mentioned, kind of an alphabet soup of regulation in the financial sector, and between the CFTC and the SEC and the IRS and FinCEN and OCC and all the rest. I mean, the idea is that nothing should ever get through the net, and yet all of this jumble of regulators means that they all treat the same thing differently. So I remember in the earliest days of crypto, right? It wasn't clear whether say Bitcoin even was money, was it an intangible asset, right? Was it a commodity? And we're still kind of working that out. But I think it's safe to say that nothing will ever get through this net because it's governed, primarily by substance and then a little bit less by form. So how are the regulators currently thinking about DeFi? Have there been any enforcement actions related to the governance tokens you just mentioned? And maybe you could tell us a little bit about, how these governance tokens are becoming more popular. Maybe you could recount the SushiSwap story, which I don't think resulted in any enforcement actions. I think it was sort of almost like a self-enforcement where entrepreneur who was trying to exit was kind of induced to reverse his actions by the community, which is kind of astonishing. I've never seen anything quite like it. Could you talk a bit about the self-enforcement versus government enforcement, and is the government doing any enforcement in the DeFi space?
Sure, and I could one up that, Gregory. So about a few days ago, I don't know if you read, but $60 million were hacked and they were all returned. And this was Poly Network. So forget Sushi Swap. This is like the biggest hack in blockchain history. And the hacker basically said, I wanted to expose vulnerability and here's your money back. So this self-enforced culture and ethos of blockchain, I think we could spend another 30 minutes. But I think like 6 months ago, people told me, June, like, DeFi is safe. Nobody's going to enforce. You can't enforce, just a bunch of codes. And I was like one of the very few GCs at a layer 1 project where I said, no, the time is going to come. A week ago, the SEC published an order against blockchain credit partners. And not to scare Tony, but they were, I think they were, offering fixed interest rates on secured assets. And the SEC characterized their operations as DeFi. It specifically stated in there, saying decentralized finance, that the way they were offering their tokens. And the result oftentimes from these SEC orders is there's a settlement, which is not too big, but there's also a continuous monitoring and banning, whether just straight up or a soft ban, like if you ever offer tokens, you have to let us know. These types of enforcement finally happened for the first time about a week ago. And when I read the order, the sense I got was, this isn't really a best example of DeFi, right? I think the SEC is slowly paving its road toward other DeFis. And I think the DeFis are feeling it. And I could tell you that a lot of GCs that work in DEXs, they've been subpoenaed. And and it's really scary because they ask you for a lot of information, and a lot of the information is just not applicable to a company that is centralized in their operations. So that also could explain, for instance, why Uniswap delisted 100+ tokens, that are stock tokens. And you're going to see this trend continue, and eventually in 6 months to 1 year, I'm not a betting man, but I would maybe bet that there's going to be a lot more enforcement actions on decentralized exchanges. And this is just the SEC. God knows what FinCEN's going to do with respect to AML KYC. CFTC has always been so silent, and tax is just a whole nother issue, right? So it's not going to get any better, is my guess.
So before
can I just jump in to say just one thing, which is, don't leave the bank regulators out, because with stable coins, they are very much a threat, that they can just decide that something needs to be considered a bank, because they can start talking about the claims as effectively deposits. And this, just to leave you with a thought on that, it's one of the reasons I think it's important to design stable coins so that they don't look like deposits. So redeemability is a bad idea, largely because it will make the stable coin look like a deposit. If it doesn't have redeemability, if it's not a debt instrument that can actually lead to a bankruptcy, you have to think ahead about the legal features of what you're doing so that it won't be taken over. And the bank regulators, I think, are an even bigger long-term threat, certainly to stable coins, than the SEC.
So Charlie, one question. A lot of people in Silicon Valley seem to think that they're a whole lot smarter than the people in DC. And there's certainly some evidence, if you go back to before the financial crisis, at least the folks at the SEC, weren't completely able to figure out what was happening on Wall Street. But I think this attitude is likely to get people in trouble. How sophisticated are the regulators, and how do they stay abreast of what's happening? Do they rely primarily on sort of incumbent industry experts to tell them what's going on? What is the level of sophistication that you saw when you're in Washington with OCC, SEC, and so forth?
Right. Well, at the OCC, it ramped up so quickly under Brian Brooks. It was really amazing. It was actually pretty amazing to me to see. And so because we had to do things the OCC had never done before, and we were thinking of chartering, and we started off, of course, in the crypto custody area, and then thinking about transactions in the network before we were even thinking about stable value coins. We never really got that far. But there's a huge amount of learning that went on, and people are willing to have lengthy seminars with us and just kind of teach us things so that we can then understand them better and regulate them. Sometimes the people who are applying for charters do that, sometimes get third-party experts. So actually, you can learn pretty quickly if you hire people, you develop a team. And I would say the OCC under Brooks, it was amazing what happened over, let's say, a 6-month period to develop capabilities. It was a very entrepreneurial regulatory group because the view was, this is the future of banking. We should be part of it. It makes sense for us to be part of it. But I would say that other regulators aren't necessarily thinking that way within the banking community. Certainly the FDIC, I did not see thinking that way. People at the Consumer Protection Bureau were not. There was some of that, but not really. And also, I would say at the Fed, this is no. So, I think you're right that the regulators may be behind the curve in their understanding generally. However, that won't stop them from doing bad things. The ignorance does not necessarily mean a lack of power, right? And they can prevent things from happening. They could wholesale prohibit things based on very little information. In fact, I say the history of U.S. regulation in finance has largely been that, including many things that happened during the Great Depression were very misguided. That didn't stop them from happening. So, we really we have to be careful about making sure to design these products, thinking in advance about what things regulators might do. And I think June's discussion of the SEC is extremely pertinent. They are definitely heading in the direction of more mandates and more examination of what's going on. And, the political winds are definitely pushing in that direction.
Great. So, Tony, why don't you tell us a bit about your company, Pledger, and what are you trying to do? What problem are you trying to solve with DeFi?
Sure, my honor, Professor LeBlanc. So Pledge is a decentralized lending protocol. We specialize in doing fixed rates and terms loan, mainly addressing the borrowing lending needs for the whales and the miners. So we are more like a platform to connect the lenders and the borrower on this platform. As you see on the lending side, there's a lot of liquidity out there. As the US government and all the government in the world keep printing more and more money, everybody is looking for stable and stable investment opportunity and yields, right? So we see there's a demand for lenders. On the borrow side, we see Bitcoin is a new asset class, and we see people who need to borrow money from Bitcoin and use that as a collateral to do other kind of investment. We can help them to diversify out of their crypto asset. I can give you an example, right? For example, I personally, I'm a real estate guy, so we see Bitcoin and real estate are a good asset class to hold for long term, and we seldom want to sell those. But at the same time, we want to do refinance once in a while to take cash out and do other things. Yeah, so that's what we are working on. I'm doing this startup because I have borrow and lender from both sides, and these are my client from my real estate world, and I want to help these people.
Well, look, I mean, you're not a lawyer, and you're wading into some territory that it's really a thicket of regulation. So how do you navigate that world, and how do you make sure you don't make investments that are going to turn out to be illegal or
yes,
sort of frustrating?
Right. Very good question. That's why I stay connect with you, right? Professor LeBlanc and Charles and Joan, right? You guys are well connected and well known in the industry, so I want to be fully compliant and fully informed. What we see is we compare ourselves more similar to Ubers and Airbnb, right? Technology comes a little bit ahead of regulations, and we want to follow what's coming and be well informed and get the legislation going, right? And we welcome regulations, right? Yeah.
So Jun, what do you think is the regulatory landscape going to look like in the next year or so with a project like, say, Tony's? I mean, he's lending, he's doing it on exchange, he's got smart contracts. I mean, this seems dangerously close to looking a whole lot like almost bank-like activity. What should he be thinking about?
Hire a good lawyer, I think.
Well, maybe you could tell us about, so for instance, the lawyers in Silicon Valley, they're usually at the forefront of a lot of different things. Yeah. I remember when I came out here and I found out that lawyers were paid with equity, I thought, wait, isn't that, I didn't even think that was possible. I learned in law school that was sort of a violation of professional responsibility. And then I realized that out here, the lawyers are always doing new things. How mainstream has DeFi become with the top law firms?
I would say you have to be very careful with law firm, and I'm not going to name any names. I think if you hire a law firm that represents centralized exchanges as the majority of their portfolio, or a law firm that is extra conservative, it could be bad in the sense that the compliance requested could be deal killing. But you also don't want to hire a law firm that is completely risk friendly. So I think a law firm, there are a handful of law firms that have struck a really good balance while also making sure that they're a pro crypto. And you want to find those law firms. Those law firms have to have basically a good understanding of all the laws we talked about. And as you know, you could study a lifetime just studying the SEC and the Howey test, much less everything else that we need to worry about. Like, I'm not strong in bank at all, so I cannot say anything about banking regulations because that's a completely different territory. So I think what you'll see is like a lot of crypto lawyers are sort of like a quarterback, and they understand at a very high level of all these regulations. And then the law firm has to have enough people to loop in the specialists so that it's hard to design a perfect business, in my opinion, but you could design a defensible business. And oftentimes that's the best option you could do in current regulatory landscape and uncertainty. And I think one more thing I would add is a legal team, whether internal or external, has to be forward thinking, right? You can't just react to the things that come out, but you have to predict, and you have to be more right than wrong. So those, I think, will definitely benefit companies like Pledge Finance as well as others.
And is there anything on the kind of legislative docket that you're seeing in the immediate future that will impact these projects?
So I'll defer to Charlie on banking side. I'm not too worried about the SEC, to be honest. I think there's going to be a lot more enforcement, but we know how they're thinking.
So Gary Gensler, I mean, he was very clear that he intended to kind of clamp down on a number of developments in this space, right?
Right. I think people were hopeful that he would come out a little bit more pro-innovation, but I think my understanding of Gary is that he's going to increase enforcement, but really using similar legal reasoning. So we know how he tests, we know how the enforcement division thinks. So that piece, it's been 4 years since ICO boom. So we have a good understanding of how to really set up the company to have a good conversation with the SEC when the time comes. I think what keeps me up at night is really sort of this AML KYC development as well as tax. So as everybody knows, there's a crypto bill that's moving through the Congress right now. that has a really wide definition of broker. And the definition itself includes decentralized exchange. So a lot of people really have to think about, is there going to be treasury regulation? Is there going to be how can I do that? And when I'm not Coinbase, right? So that's definitely piece number one. And then second piece is FinCEN could come out and say FATF, that's a great idea. Why don't we publish a guidance that says that every DEXs have to KYC? At which point, how do you react to that? So I'm not thinking that it's 100%, but it's pretty high likelihood that those things could happen. So if you're a DeFi or DeFi related companies, you definitely should be thinking about solutions potentially and also flexibility.
So I want to encourage everybody in the audience to start sending in questions on the chat, and and if you have them for a specific person on the panel, just make sure you indicate that. And while we're waiting for those to stream in, I want to circle back to Tony. Tony, you gave us a brief overview of what Pledge does. How is it different from these other lending protocols that are out there, like Compound and so forth? Is there room for, how do you differentiate in that space? Is there room for multiple players in this space? Are they all going to be doing the same thing, or will they differ depending on product characteristics, the markets that they seek out? What's different about Pledge?
Yeah, thank you, Professor LeBlanc. So for Pledge, compared to Compound, a different lending protocol like Aave, our main difference are two. Number one, we are betting on the Binance Smart Chain, and most of the lending protocol runs on the Ethereum network. Second, is that we do fixed rate and terms. Why we want to focus in fixed rate and terms is because most of the lending protocol right now, like Compound and Aave, they focus on trader and doing margins loan. We see a demand where once we do fixed rate and terms, there will be a lot more demand on the borrow side from the traditional lending world. For example, some of my clients, they want to diversify out of their crypto asset. They will unlikely to lend on a platform that has variable interest rate. They would much rather lend on a fixed rate, and they have a longer term loans. And to get back to Joan's question on getting a good lawyer, we spend a lot of money to make sure we are full compliance, and we have Fenwick as one of our legal representation, right? You will use Fenwick as our lawyer, as our law firm to represent us. Yeah.
So Charlie, question for you. One of the things that I found so interesting about the crypto space is that even though it started as something that was a radically different idea, the participants in the space are rebuilding almost all of the same type of infrastructure and architecture on top of crypto that we've seen develop on top of fiat. And you, in your article in Cato, talked about kind of bundling and how there's no necessarily ex ante reason to think that the particular bundle that makes up the modern too big to fail bank is the right one.
Absolutely.
And so is there reason to think that we're going to see entities that take deposits, make loans, offer certificates of deposit, and more or less look like a standard issue bank, except that they'll be, in the crypto space, or will we see
so there's also
a different structure?
So answering that question also helps me, because I wanted to follow up on June's opening. He asked me to fill in on the banking regulatory risk side. And it's really important to understand, if you haven't been involved in banking regulation, the current importance of the word deposit to everything. So notice that if you are a financial institution, whether you're doing the lending side or the payment side or a combination of the two, if you don't issue a deposit, you're not going to be regulated by the FDIC. If you don't issue a deposit, the Federal Reserve Board, you may have a holding company, but the Federal Reserve Board probably won't be regulating the holding company because you're not issuing a deposit. It's all baked into the regulation. And furthermore, Many people would even say that under the current definition of bank chartering, you may notice they're trying to prevent non-deposit issuing banks from being chartered. Of course, we have pure custody charters, in the OCC, there's a tradition of it, but many people who are trying to push to keep fintech and crypto from being able to have that respectability of a charter, they're actually trying to prevent you from getting a charter if you don't issue deposits. Deposits also are the key to the Community Reinvestment Act. That act, that 1977 act, many times amended, is all about deposits. If you don't issue deposits, you really, under current practice, are not subject to much risk of being, you won't be regulated by the FDIC, your holding company won't be regulated by the Fed, you aren't subject to Community Reinvestment Act regulation. That's why people, ironically, want to force the fintechs to all issue deposits so they can regulate them and make them subject to all that. What you have to do is find a way to thread the needle, not to do, if you want to do payments, find a way to do it without deposits. And if you want, and I think it's very important to recognize, Greg, as part of your question, that unbundling is a key part of the reality. And it's for good economic reasons we used to do bundling, and for good new economic reasons relating to technology, we don't need bundling anymore. But that's anathema to all of the regulators, because like in Tony's company, they're not doing things on the payment side. That's very typical of fintech firms on the lending side. But that, and you're not really, Tony, at much risk of having a regulator come after you, because there's a lot of precedent from finance companies since the 1960s and even before. They've done pure finance business and have never been a bank. So nobody can use the precedent of bank regulation very easily to say that Tony needs to be regulated as a bank. However, if you get into the issue, if you start involving yourself in the payment system and you start doing something that could be interpreted as effectively like a deposit, that's where I see the real risk. So I think the economics is pushing for unbundling of these two sides of these two different functions of banks very hard. The regulators are going to fight it, because unbundling will mean that there's a increasingly non-depository financial intermediation, and that means that's not what they regulate. So the word deposit is absolutely key in understanding how to think about this.
And by deposit, you mean demand deposit? So Tony,
No,
stay away from
not
the term
just
CD.
demand deposit.
So like
Deposits. So
yeah.
You have to, as part of your strategy, you need to understand, if you're in this business, what is the legal meaning of deposit?
Mhm.
How does it affect who regulates you? And what is it that you're doing, and how is it close to or similar to a deposit? That will matter a great deal. So we know that you can issue commercial paper, which is a lot like a deposit in many respects, and that's not subject to regulation as a deposit. Finance companies issue commercial paper and have done so since the 60s and the 70s especially, but they're not subject to bank regulation. So, but you have to be very careful, because if you start making your design produce things on the payment side that look like deposits, people will decide to broaden the definition. Why? So they can subject you to the Community Reinvestment Act. So the Fed can be in charge of your holding company regulation, right? So the FDIC can regulate you and charge you a premium. That's why you have to be careful. It's not so much on the loan side, it's on the payment side that the real regulatory risk incursion, I think, is there.
So we have a bunch of questions from the audience. I'm going to work backwards. One of the questions is, do we see a lot of people staying away from kind of US jurisdiction because of US regulatory requirements? I mean, I remember a couple months ago, I wanted to short the Dogecoin, and I had to, there's nowhere to do it in the US. It's impossible. You couldn't do it. You had to go abroad in order to do this. Do any of you see a danger that the U.S. could kind of lose its edge and lose its lead and dominance in the space if a lot of the exchange activities are domiciled elsewhere? Start with you, June, or Tony.
Tony, please go ahead.
I'm sorry, what was it? I'm just seeing there's some chat messages.
Yes, so the question is about, is there a danger that activity will move off US shores because of regulatory concerns?
Good question. So for us, we try not to focus on the US market because there are a lot of regulations, right? So one example is, for example, our upcoming public sale, it's only for non-US citizens. So we try not to deal with US investor, mainly because we need to have different registration. Also, we want to primarily focus on doing the business outside of US. Yes.
And that's a pretty strong answer.
Yeah.
Yeah.
June, are you seeing a kind of concern about US forum, US operations?
Yeah, absolutely. From where I sit, I think it really depends on what your business is. But like, if you're a company that got VC backing to launch a DEX, and you're now a broker needing to report individual transactions to IRS, and you have to KYC, how do you have a decentralized operation, right? Then you're going to be a centralized exchange. So if that's the case, then I know at least a few companies that are asking, like, how do I move abroad? Where do I reincorporate? That discussion is already happening. But I think decentralization, at least with respect to SEC, helps a lot, right? So if your protocol itself is designed such that, like, it's not one person controlling the entire operations, then there's some comfort there in terms of your operations at a protocol level. But if you're a UX UI company, or if you're touching the customer's money and you're picked up by these regulations and things that you need to do, those companies will, in my opinion, move abroad because the compliance cost is, in a decentralized sense, not workable. So I think if this goes through, you're going to see a lot of movement, but I'm not really sure if, like, there is a particular jurisdiction and whether that, like, this could be a global trend as well, right? So I'm not really sure how that's going to play out, but definitely companies are asking that question.
Right. So we have a couple questions around DAOs, if anybody wants to chime in, and then there's another question about stakeholders having to make deposits in order to participate in the consensus protocol in the new Ethereum release. Anybody want to chime in on either one of those?
I could start the DAO, and I'll defer to others on the deposit piece. So I think DAO helps. We have to remember, again, alphabet soup, right? DAO stands for this proposition that you're so decentralized, and basically there's no legal entity. There's like the state law Wyoming LLC, but I'm not a big fan of that. Mm-hmm. But assuming the maximalist view of DAO, things are happening in the ether, right? So shapeshift, announcing, and those are all good. But if you take a step back, right, and think about what really DAO is, you could only convert to DAO when your operation reaches maturity. By having DAO, you're not going to have employees. You're not going to have a bank account. You're not going to have a Coinbase account. OTC traders are probably going to be all brokers anyway and licensed under the FinCEN. And you can't enter into a contract. You're not a legal entity. So DAO really is, in my opinion, a result that certain projects should reach. And I'm not really sure any of the companies wanting to avoid regulations through DAO conversion is really a viable solution. It should be more of, like, this is what you're planning to do for the next 3 or 4 years. So I'm not really thinking that that's a viable solution. And that's really for the SEC. And, if you're a broker and if FinCEN and banking, like, I'm not really sure how DAO helps there either. So I'm a little hesitant.
Listen, this has been just fascinating. It's just the beginning of a conversation. I think we could probably talk for hours. And I highly recommend that people check out both Charlie's work, not only the recent article on on fintech, but of course his work, which goes back over 30 years, on the history of finance, on regulation of finance, on the logic of banking. And I want everybody should continue to follow Tony and his project. Check it out. If you haven't learned a bit about Pledge, go to pledger.com, no, pledger.ai, I think it is, right, Tony?
Pleasure.finance.
Pleasure.finance, right. We can put that in the chat. And I think at this point now, Tony, we're going to send everybody out
right.
breakout rooms.
So I just want to quickly have a closing remark. I really appreciate Professor LeBlanc, Charles, and Jung for participation. So Professor LeBlanc need to go. We have set up breakout rooms. So each of the speakers will be assigned to different breakout rooms, and we can have more intimate conversation and do some networking.
I'm really sorry that I mean, Greg had told me it was a 1 hour thing, and I
think Charlie has to go too.
Really switch it up.
I see. Got it. So Jung, can you stay around or?
Sure.
Yeah. So Jung and I will be hosting different breakout rooms, and we can continue the conversation. So it's more for smaller breakout room, and we can have some networking, and we can have more in-depth discussion. So I truly appreciate all your participation. And the next thing is September 24th will be our next event. It will be at the Stanford Faculty Club. We'll be hosting the Stanford DeFi and NFT Summit 2021. So you can join in person, or you can get in Zoom, and we'll talk more.
All right, great. Thank
Tony,
you.
thanks very much. And one piece of advice, now that Brian Brooks is not employed, you might invite him to participate in one of your events. He's pretty interesting.
Great. I certainly will do that. Yes. And and everybody can follow us on Telegram. We will have airdrops coming out. You can follow us on Telegram and Twitter. Twitter is Finance Pleasure. Yeah.
Thanks, everybody.
Thank you. Yeah. So you guys can stay around, and Jonah will assign us into different breakout rooms. Yeah. And thank you, Joan. Thank you for coming to the event. Yeah. Yeah. Hey, can you get Jonah to assign us to different? Okay, great. Stop the recording. Yeah, great. And he can stop the recording. Sure. Thank you. Yeah, and we can do more in-person networking. Hi, I'm Tony. Hi.
We met before.
You met in Berkeley China Summit.
Really?
This is Suki. She's one of my friends. She's a graduate from Berkeley.
Yeah.
And
Hi, Suki.
you two met
Really?
2 years ago in
Yeah.
Berkeley China Summit.
I-
You were
I
very
used to-
interested in the idea.
Yeah.
Really?
I was doing Cashmere Design Studio.
What were you doing?
Cashmere Design Studio.
Okay.
Like fashion brand and something.
Okay.
And I talked to you. And we both speak Cantonese, right?
Yeah. Okay.
Yeah.
Okay.
And now you're on WeChat.
Yeah. Okay. Wow. I didn't recognize